The 2018 Public Inspections Report was issued by the IRBA in February 2019. This recording will deal with the report and only specific aspects of the report as far as it relates to the firm reviews and the engagement reviews. This report is the third one in the so-called sixth cycle. A cycle in IRBA terms is a 3-year period of reviews, and the sixth of those 3-year periods has just finished. So in a way, this report summarizes the sixth cycle as well as the 2018 year. The inspection results are presented in a similar way to the way it was done last year, and that is according to themes. They did not analyze the inspection results of small and medium-sized practices separately. It's part of the overview of all the inspections outcomes, as it says here. There is a summary per firm of the JSE accredited firms, but we'll get to that later, and that's anonymous. The important point that they make in the beginning is that the inspections process follows a risk-based methodology. So they selected their inspections based on the risk indicators. What's important to note by that, or why that is important, is that the sample is therefore not a statistical sample. It's obviously focused on the high-risk areas. And therefore, it's important that no conclusions be drawn from this in terms of percentage of compliance or not complying, etc. The report is broken down into the following main chapters. Number 1 is the background and focus areas. We'll look over that quickly. Then number 2 is the overview of inspection results. We will look at that. 3, the key inspection themes. And there we are going to look at 3.2 and 3.3 specifically, spending most of the time there in the firm-wide inspection and the individual audit engagement inspection themes. They also include chapters 4, 5, 6, and 7 that we are not going to cover here. I will look over it quickly and show what's in there, but I'm not going to cover it in detail. That is the whole remedial action process, the sanctions for failure or unsatisfactory outcomes, the future outlook, and then 7 is an overview, a schematic overview of the IRBA inspections process. So if we can move on to the background and focus areas, the background is that IRBA just wants to explain here that there are 2 types of firm inspections, or 2 types of inspections. That's the same as in previous years. There are inspections of the firm-wide systems of quality control, and then inspections of individual audit engagement files. Firm-wide systems, they look at obviously the systems as far as the firm is concerned, and then they select engagement files specifically. Focus areas, they decide on certain focus areas for an inspection cycle, and then they focus on those areas, obviously. It's a risk-based approach, so they select audits of listed entities, public interest entities, state-owned companies, looking at research in the press and etc., where the highest risk is, and then they select entities based on that. Obviously, because of what the profession went through last year, in the year under review, there were a lot of high-profile cases that were investigated. So they took longer to review these high-profile cases. The effect was that, as you will see now when we look at the coverage, that they covered slightly less engagements than they did last year. Here is an overview of the coverage. If we look at the, first of all, the firm-wide inspections, they did 199 inspections at 111 firms. 111 firms. The previous year was only 101 firms, so it's slightly up from the last year. But what is down is the firm-wide quality control is only 11 firms were reviewed in 2018, and in 2017, 23 firms were reviewed. So it's a lot less. And in terms of the audit files inspected, 188 this year as opposed to 197 last year. So if we can look at the results, and again it's important not to draw conclusions on the overall population because the sample was not representative. Of the 11 firm-wide inspections reported, 7 were deemed satisfactory, 7 out of 11 at 64%. 3 were unsatisfactory, which is 27%, and 1 was referred to investigation. So 64%, about 2/3 of firms were deemed to be satisfactory this year. Then they also take this, as I said in the beginning, in terms of the 6-cycle review in total for over the 3 years. And over the 3 years, they've selected 54 firms for review, of which 23 were satisfactory. So that gives a percentage of about 43%. So last year's was slightly more than the years before, but again, not statistical, so it's not a valid conclusion. 43% of what was inspected in the 6th cycle were deemed satisfactory. 27 unsatisfactory, so that's exactly half, unsatisfactory, and 4 were referred for investigation. Obviously, being referred for investigation means that they are considered to be serious problems in those areas, and the investigation committee of IRBA was requested to investigate it further. Then, looking at individual audit file inspections, as I said earlier, 188 audits were inspected, 101 were deemed satisfactory, so that's just over 50%, 54% in fact, were deemed satisfactory. The rest either unsatisfactory or 14% were referred for investigation. If we take that to the 6th cycle as a whole, 622 reviewed, just over 50% were satisfactory. Just under 50%, 47%, 289 satisfactory. So if we look at over a 3-year period on the files specifically, just under half of the files were considered to be satisfactory. Just under half of the reviews were considered satisfactory. Then they list the audit engagement inspection results per firm, but only for JSE accredited firms. So that's obviously the bigger firms, and there's something like 20 or so firms included here. Some of the bigger firms are included, and you can see here that it's obviously anonymized, so we can't see who the firms are. It's clear who the big 4 firms are, and you can see that the percentage ranges from firm B, 82% satisfactory, to firm F, that was only 28% satisfactory. Firm E, obviously 0%, but I think that sample is far too small to draw any conclusions. The firm only had 12 inspections. So if we look at slightly more meaningful results, the pass rate is anything between 28% and 82%. Then there was another initiative that IRBA found. They were obviously not happy with the review results, and specifically on the big international networks. And they decided to take this, the inspections committee decided to take this to the IRBA board and ask the board to do something serious about it, because they were seriously concerned about ineffectiveness of the network firms' systems of quality control. So they took this to the board, and the board has tasked the Director of Inspections to communicate with the different levels of firm leadership. And in terms of the 6 international networks, or 6, we don't know which 6 international networks, the following board steps have been introduced. And I'm not going to go through all of those steps, but that basically means that they talk directly to the Chief Executive Officer, sometimes without the risk and the quality control partners, and they go through that process, and after speaking to the leadership, they go to different levels of leadership, and they go back after a while, and in the end they speed up the next review. So it's to make sure that the network firms receive more special attention, because they obviously weren't happy with what they saw there. It looks like the network firms are cooperating, and IRBA is happy with what they are getting from that. No doubt it will be reported further, and hopefully there will be some improvement. Okay, moving on to Chapter 3. Chapter 3 deals with the key inspection themes, and this is also the main part of this recording. They have, under Section 3, there's 3.1, 3.2, and 3.3. 3.1 is the definition of a finding or a deficiency. I'm not going to deal with that. 3.2 is the themes on an overall firm-wide level. and 3.3 covers the themes on a file level. So the themes on an overall firm-wide level are divided into the 6 different quality control elements that are currently in ISQC1, and then at the end they also add a bit on reportable irregularities. First of all, just in terms of the statistics, as we mentioned already, in 2018 11 firm inspections were performed. In 2017 there was 23, and of these 11 firms, significant deficiencies were reported in 4 firms. So the following findings were reported in these 4 firms. Section 1 deals with the leadership responsibilities. Leadership responsibilities is the section that describes the responsibility of the firm leadership as far as quality control is concerned. And this area has received a lot of focus in the 6th cycle, and it will continue in the 7th cycle. The focus would be increased in the 7th cycle, in fact. Basically what it is saying is that the leadership of the firm is ultimately responsible for quality within the firm. And if the leadership doesn't take responsibility, then the culture of the firm is going to be wrong and the quality is going to be wrong. So IRBA draws a conclusion here that some of these weaknesses that we have found are an indication that firm leadership is not sufficiently promoting a quality-orientated internal culture or fulfilling its responsibilities to ensure quality within the firms. And then IRBA makes a couple of points about the relationship between the tone at the top, the leadership's action, and the culture of the firm. They say that firm leadership needs to become much more involved during the firm and the audit inspections. Apparently they have found in a number of cases where the firm leaders, let's say the CEO, is not involved in either the IRBA inspections process or the internal monitoring process. So obviously if they are not present at the meetings, it just seems like they are not that interested in quality. They also encourage the leadership of the firms to communicate and monitor common weaknesses that were identified. If something is found, it should be communicated and monitored, communicated to the whole firm and then monitored to make sure that we do something about it. And on that topic, the root cause analysis sometimes identifies aspects that relate to matters under the control of the firm leadership. So if something like that is identified, IRBA encourages the firm leadership to support the engagement partners. If there are issues, for example, training or recruitment or something where the engagement partner doesn't have a specific control over that area, then the firm leadership is encouraged to look at how they can support the engagement partners in order to end up with a quality culture at the end. The IRBA has also made the point a couple of times that the firm leadership is required to obtain reasonable assurance that audit quality is appropriate on all audits and not only on those that were subject to the firm's own internal monitoring review process. So what that means is we know which files are reviewed by the firm internally. The firm leadership shouldn't only be satisfied that those files were good. The firm leadership should also be in a position where they can sign off with reasonable assurance that all files are of a consistent quality. So there must be a system around the production of those files, that even if those files are not subject to monitoring or re-review or EQCR, even then those files are at the appropriate level. And then the last point, very important point, is that firms should not attempt to manipulate the process. Firms should not attempt to predict what files will be inspected by IRBA and fix those files, or have a higher quality for the IRBA files and lower quality for other files. Firms should rather dedicate their resources to a more sustainable approach of improving quality on a sustainable level. The second aspect of quality control that this report deals with is the ethical aspect, and under this they deal with independence, and specifically relating to Section 90, subsection 2 of the Companies Act, that says that there are certain companies where auditors are not allowed to prepare the financial statements of the company. Or in fact, the preparer is not allowed to be the auditor. And they still find issues where auditors contravene this section and they prepare financial statements where they are prohibited from doing so. And also there is the section or the requirement that was published in section in 2015 that auditors have to disclose in their audit report how long they have been the auditor of the firm. It's known as the auditor tenure rule. Auditors seem to disclose it, and that's only for listed companies, listed public interest entities. Auditors seem to disclose it, but they don't verify the accuracy of the numbers. In the audit file, you must somewhere say how you've determined that you have been an auditor for 14 years or however many years. They found that in some instances, when they compare this with the SIP-C records, that actually some of the amounts are incorrect, inaccurate. They actually conclude that a lot of the deficiencies that are reported in this report can be drawn back to a lack of independence, where auditors are not sufficiently independent, where they are too familiar, where they are too close to the client, and that was the root cause. In some instances, auditors don't even know that they were not independent, and therefore they do not assess the evidence as objectively as they should have done. And some firms just simply didn't even have processes and procedures in place to ensure compliance with ethical requirements. For example, there should be systems and controls to identify and communicate all reported ethical and independence breaches, so that people who have not been independent are known to the firm leadership, and the leadership can act appropriately. It's not necessarily any desperate action needed. It might just be necessary to move someone from the engagement or in a different part of the audit engagement or something like that. On the topic of ethics and independence, the IRBA has implemented in 2018, or legislated in 2018, government has legislated, the principle of mandatory firm rotation, and that will start in 2023. So it's obviously not applicable yet, but IRBA says that they are monitoring if firms are prepared for this. So I would think firms that are especially reliant on one client that is going to be subject to firm rotation are going to have to look at it very carefully. This third element deals with the acceptance and continuance of client relationships and specific engagements. And considering what happened in the profession over the last year, it is understandable that IRBA is paying more attention to the acceptance and continuance of client relationships. Why would auditors take on a client knowing that the client management lacks integrity, or that there are questions about the integrity, or knowing that the previous auditor has actually resigned from the client because of certain questions to do with integrity? Why would another audit firm be prepared to accept this engagement? You must have good reasoning in place, otherwise IRBA is going to question it, and IRBA is going to pay a lot more attention to this in the future. Also, not only taking on a client, but also continuing with the client. Are we still able to continue with the client if the firm has grown significantly? So the firm is now countrywide or actually even international. Is the firm still able to service that? Do we still have the resources to service that client? Well, so we need to pay a lot more attention to the client acceptance process, and we need to be able to justify what we are doing. IRBA is going to focus a lot more on these issues. Point 4 deals with human resources. Performance appraisal process comes out here. Some firms don't have performance appraisal processes. I would think specifically for the high-level employees, the managers, the professional staff, because at the trainee level we normally have sufficient performance appraisal processes in place because they're under training contract. But at a high level, no performance appraisal process. Also, when doing the root cause analysis, a lot of the root causes that are identified relate back to insufficient personnel or personnel who don't have the required competencies. And this is a complaint that we hear often. Basically, what IRBA is saying in this report is that it needs to be fixed. If you do not have the appropriate human resources to perform a certain job, then you really can't perform the job. You can't compromise when you don't have the right human resources. So you need to find a way to get it right. because it is a very important aspect of quality control. Then they also noted what they call poor consequence management. That's when somebody has failed on a quality level and the consequences are not managed appropriately. There are no consequences or insufficient consequences. Then point 5, that's the biggest section of the review of a firm, and that is the actual performance of the firm, and performance of the engagements. And under engagement performance, they also cover quality reviews. A quality review, the internal quality review, is part of the engagement performance. And they have found a couple of weaknesses as far as the engagement quality control review is concerned. Here are some examples of some weaknesses on EQCR. Firm's policy may require an EQCR, and it was just never done. So we need to be very careful that we identify that in the beginning and do it properly. Some firms relying quite heavily on the service of external consulting firms to perform the EQCR roles. Now, there's nothing wrong with relying on external consulting firms to perform your EQCR, but you must be careful that you don't rely too much. If that firm performs your EQCR and they do your training and they are consultants and they write your audit approach, etc., are you still really able to perform that job, or do you still have enough resources to perform the job? Independence and objectivity of the EQCR, so that's on the same topic. Is the person who performs the quality control review actually sufficiently independent, or were they too involved in the decision-making process? They also want evidence or documentation of that we have the right EQCR for the job, that we have selected the right audits, and that the EQCR is looking at the right parts of the audit. Remember, it's not necessary for the EQCR to re-review the entire audit. They should re-review areas mainly where there's significant judgments, and that scope must be appropriate. The timing of the EQCR work is very significant. Apparently some instances were found where the EQCR only signed off at the end of the audit. That's not good enough, because the EQCR should review the planning and the risk assessment stage, definitely. And there were even some instances where the EQCR signs off after the end of the audit. That's also not good enough. The EQCR should sign off before the audit report is allowed to be signed off. There's insufficient documented evidence that the recommendations of the EQCR were implemented. And then lastly, the IRBA reviewer would obviously re-review this file. If they re-review the file and they find findings that the EQCR didn't find, then that implies that the EQCR was not effective, and there were numerous issues like that concerning the EQCR. If we carry on with file file performance, completion of the assembly of final engagement files. Remember, the engagement file has to be assembled in terms of the standards no longer than 60 days after the audit report. It must be locked down, and that doesn't seem to be happening in all cases. They also found instances of file tampering, where after a file was completed and locked down, it was still tampered with. Documentation or specifically audit evidence was added. That's clearly unacceptable. And then moving on to the last element of quality control is monitoring. Monitoring is the firm's process of monitoring the quality of its quality controls. Also similar to EQCR, where the IRBA re-reviews a file, and they find findings that the firm's internal monitoring reviewer didn't find. That obviously casts doubt on the reliability or the efficiency, effectiveness of the internal monitoring process. Insufficient documentation of the level, competence, independence of the monitoring reviewer. So we should have an independence declaration, CVs, etc., of the independent reviewer on file, and we should obviously consider if that is the appropriate person to perform the monitoring. Internal reviews can become predictable over time, because we know where the public interest is and which files, and we find, or IRBA has found, that there's some of the quality monitored files are at a higher level than the non-monitored files. And then once the monitoring has taken place, some firms still fail to act on it. to act on the findings. They need to evaluate the findings, they need to communicate those findings to the firm, and they need to remedy those findings. So those are the findings as far as the firm-wide reviews are concerned. Right at the end, they also add a section dealing with reportable irregularities, because they look at reportable irregularities at the firm level as well, and they have found that firms don't necessarily have a reliable process in place to process the reporting of RIs, that sometimes the RIs are reported too late, especially the timing of the second report. It has to be done within 30 calendar days, and sometimes that's too late because firms don't have policies or processes in place to ensure that. And in the last paragraph, they just summarize the main source of findings, and they say it relate to financial statements and accounting records, like financial statements not prepared within the allowed time frame. Section 30, subsection 1 of the Companies Act requires financial statements to be prepared within 6 months, so that's a source of reportable irregularities. And then also registration for taxes and levies, not declaring taxes and levies, those sorts of errors and deficiencies are a great source of, a big source of issues or findings. Moving on now to the next subsection in this chapter, and that relates to the findings on individual audit engagements, as opposed to the previous section dealt with the firm as a whole. This deals with individual audit files. And the first point that is made in this section is that there's a stark resemblance to the findings presented in 2017 and 2016. You will see as we go through these that the findings that are reported here are very similar to what was reported the last time. And that's obviously a concern, because it looks like there's not much progress in this. The findings are under a few headings. The first heading is revenue. Quite a lot of findings under this area specifically. Obviously, being a significant risk area, it's presumed to be a significant fraud risk area in terms of the standards, and there are a lot of weaknesses found here. The first finding relates to general points in the beginning of the revenue audit process. The risk assessment process was not robust and not properly documented. There are some issues relating to audit sampling, the completeness of a sample, where the sample is selected from, direction of testing, etc. The assessment of controls, and still inadequate walkthrough tests. Those are all reported in the revenue testing section. Apparently the rebuttal of the presumed fraud risk is still an issue. Presumed fraud risk can be rebutted, but the standard ISA 240 explains exactly when it can be rebutted, and it says that it's actually very unusual, and it seems like some firms actually take that as a default practice. That is not acceptable. It can't be the default. The rebuttal of presumed fraud risk is actually unusual. The old problem of completeness of revenue is still a problem, that we don't get completeness of revenue right, not testing it from the appropriate source, not documenting the completeness appropriately, not actually performing the appropriate tests. Some auditors use analytical review procedures to test completeness of revenue. Remember, analytical review procedures can only confirm completeness of revenue if that analytical review is predictive of nature. And then obviously, if in some entities you cannot predict revenue, and in that case, analytical review is not an appropriate test. Analytical review, by comparing this year to last year, is just not sufficient to test completeness of revenue. Then they move on to occurrence of revenue. That's the other side of the coin. If completeness of revenue was a problem, occurrence of revenue was also a problem, because that's the other side. If you have to test that everything that is recorded in the income statement as revenue was actually valid revenue. So you test it from the end product back to the origin of the transaction. So that's revenue. The second section under this subsection is significant estimates and judgments. A lot of issues found here, and you would expect this to actually grow. It actually is not going to become any easier, because the new standard on on estimates and judgments was just issued last year, towards the end of 2018, and that standard changes the rules quite significantly. It's only applicable from a year from now, so there's still some time, but we have to look differently at the way that we audit estimates and judgments. The examples that I mention here is findings related to professional skepticism. If the client makes an assessment of the recoverable amount of goodwill, here's some examples: valuation of other intangible assets, not goodwill, other assets; useful lives and residual values of property, plant, and equipment; valuation of certain financial instruments. The client makes that assessment, then we have to, as auditors, assess that with professional skepticism. You can't just, because the client understands what they are doing, just assume that they have done it correctly. We have to be skeptical about that. Still on the same subject of estimates and judgments, inappropriate reliance on the work of experts. You're allowed to rely on work of experts, but you still have to be skeptical about it. You still have to look at their qualifications, at their independence, at their methodology. You have to look at the input data that they used. And a specific area that IRBA uses here, or that IRBA mentions here, is the area of the valuation of investment property. That continues to be problematic, where we place too much reliance on the work of experts, because they are the experts. We believe that they will always get it right, and that is, in fact, in practice, not necessarily correct. Then back to the old problem that we have of useful lives and residual values. We are still not assessing that appropriately. Depreciation. Did management depreciate correctly? Still referring to componentization, the assessment of should an asset be depreciated in its components or as one single item. Acquisitions and business combinations, we don't provide evidence of the assessment of management's judgment. For example, was a business purchased, or were the shares in the company purchased? And I think that those judgments are often made, but we just don't document it because we think it's so obvious. We must make sure that it's documented properly. Then remember that the economy at the moment is in a difficult environment, so it is a lot more, we have to be a lot more careful to justify the recognition of a deferred tax asset. IAS 12 requires that deferred tax assets can only be recognized to the extent of future taxable profits that these can be utilized against. And in a difficult environment, the extent of future taxable profits could become questionable. Therefore, your assessment of the allowed recognition of a deferred tax asset should also become a little bit more thorough. And staying on the concept of the difficult economic environment, that has presents other challenges to the businesses. For example, going concern. If a business was doing well last year, if the economy is in a downswing, or the suppliers are struggling, or there's a shortage of resources, then we may find that going concern comes into question. And as a result, also goodwill for certain aspects of the business, maybe impairment is a concern. Some other intangible assets and their valuation. Debt covenants are mentioned here. Maybe the company has certain debt covenants that they've never had a problem with complying with, and now all of a sudden it can become a problem because the economy is under pressure. And then there's some, what they call the auditing principles, failure to comply with just our general auditing principles, and that's under the heading of planning, fieldwork, and completion. Under planning, we mentioned already that auditors do not document the reasoning for concluding that the risk rating is significant or normal. The reasoning isn't documented sufficiently. We don't take that risk assessment down to the level of the assertion. And it has to be all the way down per account balance, transaction level, and the level of assertion. Related parties and management override of controls. Remember that risk is again presumed to be a significant risk. I see the report at the end of this paragraph mentions reducing or rebutting the risk. the risk in related parties and management override of controls, I believe, actually can't be rebutted. It can never be rebutted. It is only reduced by audit procedures. Materiality, in some cases materiality is not calculated and documented. In some cases the basis for materiality is not documented. In some cases it's done but too aggressively, so the materiality assessment was too high. Remember, there is scope for professional judgment here, but if there are some cases where it is just clearly too high. It's just beyond what a reasonable user would consider in his decision making. And then a lot of issues regarding audit sampling still, regarding sample sizes, sample size not linked to the risk identified, sample size is not in compliance with the firm's methodology. Each firm has a methodology of how many they test for controls, etc. And we have to adhere to those methodologies, otherwise we are going to be open to question. On the area of fieldwork, I'm not going to go through the fieldwork findings. You'll see that these are the ones that we've come to expect over the years. That's the common findings that have always come through these reports, and even internal monitoring reports, we've seen these findings a lot of times. And if necessary, you can go through the report on your own to familiarize yourself with these findings. Then there's a section dealing with the completion stage of the audit. Firstly, errors, exceptions, misstatements that we find during the fieldwork are not carried forward onto the completion stage where they can be reassessed. So they must be carried forward to the schedule of unadjusted differences or points for partners' attention or whatever you want to call that, so that it can be reassessed at the end. When they are carried forward to the schedule of unadjusted differences, this schedule is not considered appropriately and carefully enough. There's even cases where if you look at the reasoning, it looks like the auditors are trying to document the differences away. The auditors are trying to justify why differences shouldn't be material and do not have to be adjusted. That's not the objective of this schedule. The objective of a schedule of unadjusted audit differences is to objectively consider whether they are going to affect the user's opinion. And obviously, they have to be considered on a line-by-line item and on an overall per section level. And not only qualitatively, but not only quantitatively in terms of amount, but also qualitatively in terms of the impact that these potential errors can have on the user of the financial statements. Schedule of unadjusted differences is sometimes not reviewed by the engagement partner. That's, I think, inexcusable, because that's the main area I think that the partner should review. That's the final summary of the errors that we found. Management representation letters not being signed or signed after the date of the audit report. Subsequent events and going concern procedures, either after the date of the audit report, which is clearly not good enough, it should be done before the date of the audit report, or long before the date of the audit report. In cases where the audit report signing process is delayed or drawn out, it might be necessary to go and revisit the subsequent events and going concern assessment and update it before the audit report is signed. Next heading is on audit evidence and audit documentation, and just to point out here that IRBA still follows the approach of if it is not documented, it is deemed not done. That is the IRBA approach. Something's not documented, they're going to assume that it's not done, so make sure that if you have done something that it's documented. Then lastly, professional competence and due care. The conclusion that is drawn here is just that auditors are not sufficiently careful when they do the work. They don't apply professional competence and due care, and that's why so many findings have been reported in this and other reports. There are lots of findings on disclosures, restatements. Sometimes in financial statements, prior year figures are restated without indicating whether it's a correction of an error, and if we complied with IAS 8 and IAS 1, for example, presenting a third column balance sheet. Insufficient disclosure of IFRS 7, financial instrument disclosures are insufficient. IFRS 13, if the valuations are in the fair value hierarchy, to disclose the hierarchy, and there's also additional qualitative disclosures for level 2 and level 3 instruments that fall within that hierarchy. We mentioned IAS 36 already. Goodwill, the impairment assessment, there's some extra documentation or extra disclosure required there. Then, dealing with the disclosure of directors' remuneration. Remember, Section 30 of the Companies Act requires directors' remuneration to be disclosed for certain entities, not all entities. But if the entity is subject to that section, then the director's remuneration has to be disclosed per director, not in aggregate, and the director's name, not Director A, B, C, D. Also, that disclosure, if it's made, there's insufficient audit evidence where that has been audited. Remember, you can't just get the numbers from the client and put them in the financial statements. They must be audited. And also, don't forget about the effect of remuneration that the directors have received from other group entities. Section 30 requires remuneration that the directors receive from other group entities to be disclosed in the company's financial statements. The classification between current and non-current, specifically for assets, liabilities. Current assets and current liabilities, remember there's a difference between assets and liabilities in terms of the current and non-current classification. For example, a liability, if there is no irrevocable, unconditional right to defer payment beyond a year, then that liability is a current liability. Otherwise, there must be an irrevocable or unconditional right to defer payment beyond 1 year to be a non-current liability. For current assets, it's almost the opposite. It's a different consideration. So we have to be careful with classifying balances between current and non-current. Then under Section 4, they list a couple of other areas of significant findings. Cost of sales is still an area of findings. Goodwill. Specific examples, goodwill is tested at the wrong level, so not at the lowest cash generating unit level. In fact, we do normally test it at the lowest cash generating unit, but we don't justify in the audit file why we think that this was the appropriate lowest cash generating unit and there is no lower cash generating unit that can be used. We mentioned the inputs and testing of goodwill already, insufficient disclosure of goodwill, we mentioned that already, and auditors not understanding what the goodwill relates to. If the goodwill specifically related to aspect of the business that was bought a couple of years ago, and that part of the business is not operating anymore or not so successful anymore, then we need to consider if that goodwill perhaps needs to be impaired or even written off. Jumping to IFRS for SMEs. In IFRS for SMEs, you're allowed to amortize goodwill, but you have to justify the amortization period in the file. And insufficient documented audit evidence of figures used. We referred to that earlier in terms of professional skepticism specifically. Related party transactions. Remember, related party transactions, if they are outside the ordinary course of business and they are significant, then they are deemed to be high risk, fraud risk areas. And that has to be dealt with accordingly. Significant areas, that's the word, not high risk, significant areas. Some findings on the audit report still. Wrong accounting framework specified. So we say that it's IFRS, but it was in fact IFRS for SMEs. Wording is not in accordance with practice statement SAPS 3. They refer here to SAPS 3 that was revised in November 2015. At the time of recording, making this recording, exposure draft was out for SAPS 3 already for the 2019 version. So I suggest you look at the 2019 version as well, or the exposure draft. The audit report stated that the auditor had issued an opinion on consolidated financial statements, whereas in fact consolidation was not done. And we have to look at that very carefully and look at the impact of the consolidation or non-consolidation on the audit report. We're going to talk about it in the next section, and that the impact is going to be more than likely an adverse opinion. On the cash flow statement, some findings relating to mainly inclusion of non-cash flow items on the cash flow statement. We have to find a way to make sure that we identify non-cash flow items and do not include them on the cash flow statement. The cash flow is not simply just the difference between last year and this year's balance sheet. Non-cash items have to be excluded. Why IRBA is getting stricter on this area is because cash flow ratios are used by analysts and other users. So if we get that figure wrong, then obviously the ratios are going to be wrong. Then, returning to consolidations, IFRS and IFRS for SMEs would allow certain scenarios where you are exempt from preparing consolidated financial statements. Those scenarios are quite restricted. You must be very careful then that when an entity controls another entity, they must consolidate unless they comply with one of those conditions. And as I say, that's very seldom. So we have to be very careful with consolidations or not consolidating where a consolidation is actually required. Attorney's trust accounts, I'm not going to spend much time on this specialized area, but just to say that significant deficiencies are still found in the audit of attorney's trust accounts. Those were the general themes found in the IRBA inspections report for the 2018 period. The last couple of sections of the report are more general and deal with the remedial action process and the sanctions and the process itself. I'm not going to spend much time on it, but just to show you the main headings, section 4 is to do with the background of the remedial action process. 4.2 deals with the root cause analysis and gives in 4.3 a couple of examples of root causes identified. Please do not view these examples of root causes identified as a checklist of root causes that you can have. They are just examples. I must add that we have found a lot of benefit in doing a thorough root cause analysis. If you have the right people doing an objective root cause analysis, you are going to find some very insightful findings, and that could act to improve your system. Make sure that obviously the engagement partner is involved and the leadership is involved at the right level, but it is useful. The challenge then is to actually implement those implement an action plan to address the root causes that were identified, actual remedial actions, and that's the next step. Section 5 deals with the sanctions. So they show what can happen if you get this wrong. Those are the sanctions. There are obviously some serious ones. And IRBA, I think one can expect these sanctions to be more serious if you look at the proposals that are in front of Parliament at the moment to change the sanctions and change the legislation applicable to the sanctions framework. Then one can expect these to become a lot more harsh in future. Section 6, a couple of points on the future outlook, what we can expect. Evolving auditing standards. These auditing standards are changing. ISA ED 315 is out. That is going to change the risk assessment process. It's probably one of the most significant changes in auditing standards in recent years. That's coming our way soon. ISA 540 on the evaluation of 450 on measurement estimates and things like that. I mentioned that already. That's going to be a big change. All the quality control standards are changing. Actually going to become known as quality management standards, ISQ M1, ISQ M2, and ISA 220. They are being considered, and they're going to change the quality control process. Then there's significant accounting developments. Audit quality indicators process has started. NOCLAR is very important. There's more and more issues or aspects where we find that NOCLAR comes into play. Transparency. IRBA is now requiring transparency, or may start requiring transparency reporting. Independence and ethics. We're not dealing with the new ethics code, but the new ethics code is applicable from 15 June 2019, middle of this year. That's going to have far-reaching effects for auditors. And then the last page is just the IRBA inspection process. That's section 7 that just gives an overview of the inspection process. So this recording dealt with the 2018 report of IRBA under these headings. Number 1, the background. Number 2 was an overview, simply giving some statistics of the process. Number 3, and specifically 3.2 and 3.3, is where the main focus of this recording was, the main themes of the 2018 inspections, what was found. And then chapter 4, the remedial action process. Chapter 5, the sanctions. 6, the future outlook, and then lastly was just a diagram on the IRBA inspections process.